Okay, let's talk about Chapter 23, deciding between owning or leasing equipment. As a healthcare manager, you would be part of this decision-making process, and of course, the goal would be to make the most financially sound decision, what's going to benefit the practice or the organization the most. So purchasing equipment means taking a title to or assuming ownership of the item. You can do that by paying cash. You can do that by financing. Leasing equipment is a very popular option for a multitude of reasons. It's not something I ever personally, just side note, I don't ever recommend you leasing anything for personal reasons, whether that's vehicle, etc. It's very different for a business though, and I will get into that. I'll show you how to figure those type of numbers out. So a financial lease is a lease purchase, contract to purchase. It is something, for example, like an x-ray machine. If that is something a healthcare facility wants to buy, it may have some tax benefits to lease it versus just purchasing it or financing it a different way. So a lease is a good option for certain facilities. Contract to purchase, etc. The bottom of page 263, number 1 says you can buy the asset at the end of the lease. And so at the end of any financial decision when it comes to financing, you need to decide if you want to own it or not. Maybe you just would prefer to rent it. And speaking of renting, excuse me guys, and girls, let me sip this. Hang on. Okay, pollen. The pollen's getting me. Okay, so operating lease is like renting. Many healthcare organizations will do an operating type lease for copy machines, fax machines, equipment that's just not going to last very long, and you don't want to have to deal with selling it when it's over. So you just lease it. You lease it for 15, 20, 50, 100 years, whatever. But again, it's up to a manager or someone in leadership to make those type of decisions, and this is how they get to those decisions. So buyer lease management decisions on page 264. Got to decide where the money's going to come from and what does it look like in the long run, the benefit. Also, service agreements. So if we are leasing that copy machine I referred to, or even the x-ray machine, who's servicing it? How much does that cost? Let me back up. The operating lease is not something that has to be capitalized or placed on a balance sheet, but a financial lease it indeed does, because that's something you're going to end up buying in the end. You will own it at the very end of a financial lease. So that is one thing, you will put that on the balance sheet. Okay, so moving forward, an example on page 264, that this is a huge example. This is pretty much, this chapter is almost like a case study. But one big thing, the difference between a not-for-profit and for-profit is tax benefits or tax subjectivity to income tax is what I'm trying to say. Nonprofits do not typically benefit from leases because they don't pay taxes anyway. So just keep that in the back of your head. Not always. As a manager, a healthcare manager, you will be doing these type of calculations to determine net cash flow, the effects, what's the benefit, etc. So starting on page 265, table 23.1, it builds, keeps adding table 23.2. All those line numbers keep adding up. I'm not going to read this to you, but basically table 23, 2B1, etc. These lines keep going. These numbers are important, and it's important to remember how they're getting, like for example, on page 267, table 23, 2-C.1, the value, let me slow my head down. Line number 16 is the present value factor. Remember, that is found in our book on page, it's the appendix for 13A. So page 141, 142, I believe. Let me make sure I'm right. Hang on. Yes, page 141, that's the present value. So that table. So when you're talking about line 16 on page 267, the present value factor at 8%, go over to column year number 1. It has 0926 listed. So I flip to page 141 and I confirm indeed in the 8% column for year 1, there it is. It's listed as 0.9259. They just rounded it up for this example. So that's how they're getting these numbers. Look at the difference in that table that I was referring to just then, 23-2-C-1. That's the cost of owning for Northside Clinic. The next table is cost of leasing. So those numbers are different. And the $37,000 versus the $35,000 may not be a big deal over a 5-year period, but let's pretend that that is $37 million or $37 trillion versus $35 trillion, million dollars. Then that's when these numbers become really significant. Okay, I'm going to keep going. Page 268. So table 23-2D3 compares the not-for-profit cost of owning or leasing. In this case, it's literally a $676 difference. So it's so that's a lot of money to me. That it's so that's very small numbers when you're in that decision-making process. So there's no right or wrong. You may want to look at the tax benefit if that would offset it all, but usually not-for-profit, they don't get that tax benefit. Okay, so, and that is it for Chapter 23. Yeah, let me know if you guys have any questions. The PowerPoint is pretty good too, and just reach out. Thanks.